Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Let's talk about a critical but often overlooked piece of SBA 7A business valuations: maintenance capital expenditures, or CapEx. When we value businesses using the income approach, getting CapEx right is essential to avoid inflated valuations. Let's explore why CapEx matters, how to estimate it, and its impact on SBA 7A lending. We all love EBITDA. Earnings before interest, taxes, depreciation, and amortization. It's a quick, clean way to gauge a business's performance, stripping out debt and taxes. But here's the problem. EBITDA ignores capital expenditures. Assets like equipment, vehicles, and technology wear out or become obsolete, requiring real cash to replace. If appraisers stop at EBITDA, they're assuming a business can run forever without reinvesting, a fantasy that overstates cash flow and valuation, misleading lenders and buyers in SBA 7A deals. Maintenance CapEx is the cash spent to keep a business's current operations humming, not to grow, but to sustain. Think replacing a delivery truck or upgrading outdated software. Unlike growth CapEx, which fuels expansion, maintenance CapEx ensures the business stays viable. In SBA valuations, appraisers using the capitalization of earnings method must factor in maintenance CapEx to calculate sustainable free cash flow. Some assume depreciation, which tracks asset wear, equals CapEx. It's tempting, but wrong. Depreciation is an accounting estimate. CapEx is actual cash out the door. Valuation expert Gilbert Matthews, in his 2002 article, called this assumption unrealistic, especially for growing or inflationary environments. If CapEx consistently lags depreciation, the business underinvests, eroding earnings over time, a risk appraisers must avoid. In valuations, maintenance CapEx must always be greater than depreciation in the capitalization of earnings method. So how do appraisers estimate maintenance CapEx? Here are 5 methods. First, historical CapEx. Average 3 to 5 years, adjusting for one-time or growth items. Second, use depreciation as a starting point, then tweak for asset needs. Third, check industry benchmarks, often as a percentage of revenue. Fourth, analyze asset schedules, estimating replacement costs based on useful lives. Fifth, talk to management to separate maintenance from growth spending. These ensure realistic CapEx for SBA valuations. Asset types drive CapEx needs. Computers and tech last 3 to 5 years, vehicles about 5 years, manufacturing equipment 10 to 15 years, and leasehold improvements 30 to 40 years, per IRS and GAAP guidelines. Short-lived assets like tech demand frequent cash, hiking maintenance CapEx, while leasehold improvements need less frequent but larger spends. Appraisers factor these into discount rates and capitalization rates, ensuring the capitalization of earnings method reflects true reinvestment costs for sustainable earnings. For SBA 7A loans, maintenance CapEx is critical. Ignoring CapEx overstates free cash flow, inflating collateral, and risking repayment. For example, a business with $500,000 EBITDA but $100,000 maintenance CapEx has only $350,000 free cash flow. This can have a significant impact on the final valuation. Ignoring maintenance CapEx is like valuing a car without checking its worn-out tires or failing engine. It assumes a business can operate indefinitely without reinvesting, which is unrealistic for any operation with physical assets. For SBA 7A loans, lenders need durable cash flow to service debt and sustain operations. Overstating cash flow by skipping CapEx misleads everyone, putting loans at risk. Maintenance CapEx isn't optional, it's economic reality. When capitalizing earnings for SBA valuations, appraisers must adjust for CapEx to deliver credible valuations, and it's key to ensuring your SBA loan is backed by realistic cash flow. Thanks for joining us for this episode of the Valuation Desk. Behind every financial model and final value is a professional who knows how to interpret the story behind the numbers. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound, it's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations and machinery appraisals, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.